So Gary, I'd like to start with this chart that I found interesting that we were talking about offline. It shows gold from two different time periods overlaid on top of one another. So the blue line is 2010 to 2012, a 2-year period starting from January 2010 to January 2012. The red line is January 2019 to present day, so January 26th, 2021. And what we're noticing is that these two lines have a very close price pattern. We're seeing not just the same movement upward and then consolidating, but almost the same amount of time it takes to reach a high and then falter down and consolidate. The magnitude of the price rise and drop have also been similar. Can you comment on this similarity?
Absolutely. I mean, first, it's a great chart, David, and it shows that there is a very, very positive correlation between these two time periods, which makes sense on a fundamental basis. In both occasions, we're starting at a point in which there was an economic contraction. There was an event that really changed the nature of how our GDP was growing. And in the case of the banking crisis, in about 2009 was the beginning and really the first time the Federal Reserve implemented a kind of new facet to their monetary policy, which was quantitative easing. They began massive purchases, adding it to their balance sheet to provide liquidity, and they brought interest way down. This had the effect of taking gold literally from about $700 up to the record high with very few corrections, and that's what we're seeing in the chart. What I'm seeing is that we are seeing the very, very same kind of action because the global pandemic, which really affected the markets most in March, is also when the Fed stepped in, did quantitative easing, and they continue to buy about $120 billion worth of bonds per month. So they're swelling the asset sheet again. So you've got economic problems, you've got the Federal Reserve stepping in. And that is unique to both time periods. And I believe that's why we're seeing such a positive correlation between those two periods of time.
What I'm concerned about is that if this correlation holds, take a look at this next chart. It's the same chart, except all we're doing now is extending the blue line from 2010 all the way to present day.
Mm-hmm.
And so what we're seeing is that if we assume that the red line is to maintain this correlation with the same price pattern as 10 years ago, then isn't it possible, Gary, that we're going to see a multi-year decline down to back to 2015 lows and then a consolidation for another 2-3 years, perhaps even longer?
It's absolutely possible, but I think that it is less probable or less likely now. And that is because the unique environment we find ourselves in, not only are we doing quantitative easing, interest rates near zero, but we've spent in the first round $3 trillion of fiscal stimulus. They bailed the banks out last time, but this time they're providing capital in another way, the Treasury is. So you've got the fiscal stimulus of 3, then you add another 900 billion. That came out at the end of last year. And now President Biden's trying to push through another $1.9 trillion aid package, fiscal stimulus package. And based upon that, and based upon the timeline that it will take for the vaccine to reach herd immunity, is still, months away, 3-4 months away. My sense is that although we could see a further decline, when we look at the gold chart that I presented, you'll see, I think we hit our bottom in November of last year when the market traded to a low of 1775. In other words, in the period from 2009 to mid-2011, you hit that high of $1,920, then you had a multi-year correction. In this case, we hit our high in August of last year, and then from August through November, we had a steep correction. It basically corrected 50% from the move of March when gold was trading at 1450 up to 2088. The low matches precisely to a 50% retracement point. So I think that we could have seen a shorter correction. And this, of course, changes everything, because if we continue to have larger debt, if we continue to implement these programs that are truly needed and helpful for the millions of Americans that are unemployed, for the businesses that can't keep their doors open because different cities are locked down, that debt is going to come back one day. And there's an old saying that Barry Commoner used to say, and there's no free lunch. At some point, we will be presented with the bill for all of these expenditures. And so for that, that's the reason I think that this might be different.
Okay, so eventually these two lines will diverge.
That's possible, yes.
All right, let's talk about the fundamentals now. So current price action, not a lot of action. I think price action in this case is an oxymoron. So what's going on, Gary? What are the fundamentals what are the fundamentals here?
It is either the calm before the storm, but it's obviously that market participants are entirely focused upon the Federal Reserve meeting, the first meeting of the year, 2021, and started today, will conclude tomorrow with a statement and a press conference. And in the case of tomorrow's press conference and statement, the best news for gold traders, for gold bulls, I should say, is that no new news is good news. In other words, they pretty much committed to keeping interest rates near zero till at least 2023. Jerome Powell, Chairman Powell, has made statements to the fact that he's not going to rush to move that. They're going to be sensitive. They're letting inflation run hot, which it hasn't. And so what we're looking at is a real potential that if the Federal Reserve remains on course, meaning they continue the purchase program, because the only uncertainty is there's been some squabble as to whether or not they're going to begin to taper the purchases of mortgage-backed and bonds from $120 billion a month and start to taper that lower. That was the beginning of the end of quantitative easing back in 2012 and 2013. And that was really the spark that took gold, which hit its high and then was trading between 1800 and 1900 for a while, then 1800 and 1557, that really caused it to break below that and hit the lows of about 1,040, and that occurred at the end of 2015, beginning of 2016, ending the multi-year correction. So for that reason, all eyes are going to be on the Fed tomorrow, because I want to know if there's any signs that they're changing their basic monetary policy stance. The thing that the Fed is faced with right now is they've got a double-edged sword. On one hand, things are not good right now. The pandemic is still out of control. They are getting people vaccinated, but now there's new variants. And short term, the economy continues to contract. I read some data that suggested, the World Bank said that our GDP for 2020 is probably going to come out at negative 3.6. The Fed predicted negative 2.7%. So we had a definite contraction.
Okay, so Gary, you brought up the Fed meeting tomorrow. It seems that the market is pricing in 100% probability of the Fed rate staying where it is today. So I'm looking at just CME data, the Fed Watch tool. And yeah, it doesn't seem like market participants are anticipating a change.
Yes, that's the same data I'm looking at.
Are you, so we shouldn't be expecting any surprises then, hey?
No, I think that they're going to stay the course. And if they do, that will be bullish for gold. I think we'll see a spike to the upside if, in fact, they make a statement that they're going to continue the monetary policy, accommodative in terms of interest rates and allocation of their asset sheets, yes. Okay,
Gary, so key levels then for gold.
That's pretty easy. The chart that I put up, and just get my mouse over here so I can kind of blow that up for us. We've got three basic moving averages that you can see. The 200-day on the bottom, that is where the market is currently trading at. Right below it is the 38.2% Fibonacci retracement level. Above it is the 50-day moving average in green, and then the 100-day moving average in blue. Support levels are obviously, I think 1850 is a key and critical level to hold. Absolutely, because if it doesn't hold that level, it could move down to another area, and the area that I would probably look for would probably be the 50% at 1771. And that's this bottom right in here that occurred in November of last year. But it's held pretty good. And what I'm seeing is, you can also see that I've drawn a basic compression triangle. And so let me rescale this a little bit. When we take a look at what I call the big picture, what we can see is that from August through November, we had a series of lower lows, series of lower highs, correct?
Yes.
Then in November, we hit this bottom at 1750, and we get a series of higher highs, and we get a series of higher lows to a degree. This low compared to this low, this is higher. And then when we look at these highs, they continually got higher and higher till we hit this top here. So that it is for that reason that I think we are cautiously bullish. We realize that it has been under pressure. I think that the pressure has been coming from the fact that we've seen yields rise in terms of bonds. And that, of course, is a safe haven asset. So it's in competition.
It looks like the 100-day moving average is trending down, right?
Absolutely. That's trending down. The 200's been trending up. It's actually the opposite of what we're seeing in silver, but that is correct. But the key is this. It is held above the 200-day, and the 200-day is the most critical for a long-term market view in terms of momentum. Mm-hmm. So the longest term momentum has not gone bearish yet. It's still bullish. Short-term momentum has gone neutral to bearish. But I think that that could change. And what would change that would be tremendous expenditures by the new administration, adding tremendous debt to our already record high national debt.
Okay, so Gary, let's talk about Bitcoin now. Another interesting asset, hit around $40,000, and it's found a resistance level at $40,000. It's covering around $32,000 as we speak. The trace from the $40,000 to the $30,000 caught some people by surprise. Some people were expecting it to continue going higher. What do you think? Where do you stand on this debate?
Well, I mean, listen, anytime you get a market that has a parabolic rise, that has this kind of a parabolic rise that we witnessed, where it went to 42,730, and this is Bitcoin futures, by the way. Anytime you get a parabolic up, you typically will get a parabolic down. But on here, there are a couple of areas. This chart was presented and created actually by my son, Joseph. And what he says is key, and in terms of an importance level, is this Fibonacci harmonics. And the harmonics was created by using two different data sets. The first one's at the top of 20,000, when Bitcoin just started trading, as it moved down, and then against this rise here. And what you notice is that at this particular point right in here, you've got a green line, you've also got a number that is in blue. And so it represents these two different data sets really looking at the same price point. And that tends to strengthen the potential that this could be a potential bottom. However, what Joseph has told me is if it cannot hold this, what we would look for is a potential move down to maybe 26,328. That's our 50% retracement. What I find interesting about that idea is you see this large gap here? That would take it right to the gap. Now, the question is, would it fill the gap or not? Right now, there's the potential for support. We've definitely seen it sell from 42 down to about 32,000 right now. So we've seen a pretty good retracement. It actually went to the 38.2 and also to a 1.681 extension. Mm-hmm. So it really matches up right in this area. We'll have to see how it reacts here. But according to this chart, If it holds here, we could see a bounce up. If it doesn't, the next level you would want to look at would be about 26,300.